Hello everyone, welcome back. My name is Gift Maguju and I am a financial analyst at FundMe Capital. Today I'm going to show you how to compute the cost of equity and the weighted average cost of capital. So without wasting time, let's dive right into it. So I've set up this sheet here, Excel sheet, and you can see these line items that I've put there. And so we have got equity and we've got debt. So let's say a company wants to raise capital and it wants to raise both equity and debt. So when a company wants to raise capital in the form of equity, it has to ascertain the cost of that equity. That is the cost of raising equity. And in most cases, the cost of raising debt, is always given, like it's the interest rate. That's the cost of debt, right? So having said that, let's look at how to, what are the factors that affect the required rate of return or the expected rate of return on equity investments. Because from the angle of the company, the cost of equity is the cost of raising equity, right? But from the perspective of the investor, they don't call it cost of equity per se, they call it the required rate of return or expected required rate of return. So in other words, cost of equity is denoted by a symbol KE, whereas the cost of debt is denoted by KD. Right, so to calculate the cost of equity, in fact, the expected rate of return, the formula is, so I haven't written the formula here, so let me just write the formula there. So to calculate KE, which is cost of equity, we say risk-free rate. So risk-free rate plus beta, and then we say market rate minus risky-free. So it's a risky. Okay, so risky-free rate. So basically that's the formula for calculating the cost of equity or expected rate of return. And so the difference between market rate and market risk is called the equity risk premium, right? So we'll talk about the equity risk premium in a jiff. So let's look at the risk-free rate. What is it? So the risk-free rate is the rate of return that you get from an investment with zero risk. Right, so that's why most of the time the risk-free rate is also called the treasury bill rate, because normally if you invest in treasury bills, these are issued by the central bank, and so that's so you use that treasury bill rate, and that treasury bill rate denotes the risk-free rate. Then we've got the beta, right? So the beta just shows the sensitivity of the equity instrument to changes or to the market, right? So the sensitivity of the equity instrument to the market. So we are looking at the equity instrument, its movement against the market. For example, we are looking at the company against a certain index, the movement of a certain index, let's say the S&P, right? Right. So a beta of 1 it shows that the equity instrument or the stock is moving in tandem with the market. So which means there's low, the risk is neutral sort of. Then a beta of a beta below 1, it means it's low risk, so you can invest in that if you are a risk averse investor. But a beta above 1, it shows that the equity instrument is very, very volatile, right? So let's look at the equity risk premium. So we're saying is equity investors, they don't require a risk if they don't want to invest in investments that offer a very low return. So the risk premium is the rate of return that they demand, which is above the risk-free rate. So that's essentially the risk premium, right? And then we get the cost of equity. So having said that, let's just put some figures there so that we can get the knowledge of how to compute the cost of equity, right? So let's just say the risk-free rate, the treasury bill rate, let's say it's just 1% or 2%. So let's just change that. To change, so we want to change that cell to be a percentage. So to change that to percentage, you press on your keyboard Alt HP and Alt H0, right? Because we wanted to add 1 decimal place. So let's just say 2%. Okay, that's the treasury bill rate. So let's say this type of stock, the beta is 1. So the equity instrument is moving in tandem with the market. So let's say the market rate. So the market rate basically is computed from the data of the index that you are benchmarking the stock with, for example the S&P. So you compute the market rate there and then you input it there. So let's just assume that the market rate, let's say it's 5%. So let's change that cell again into percentage, Alt HP, Alt H0 to add a decimal place, and then let's put just 5%. So the market rate, it has to be higher than the risk-free rate. So we have got the risk-free rate there. We have got 2%. So let's just change this cell, Alt HP, Alt H0, just like that. And then we can link the risk-free rate there, which is perfect. So now to get the equity risk premium, we simply say 5% minus 2%, and then we have to change that into percentage. So now we just need to copy the same format there. So to copy that, come here and then Alt ES, and then you can say T, and then right. So we get the equity risk premium, which is 3%. So now we are able to compute the equity risk premium, the cost of equity. So we can link the equity risk premium there. Let's just copy the same format. So let's say Alt HVS, then you can say T. Perfect, just like that. So now we can compute the cost of equity. So we can simply say that 2 plus, let's say 1, and then times this, and then we can change that. We can copy. We can change that into a percentage, Alt HP, Alt H0, just like that. So which means we have got the cost of equity of 5%. So we can calculate this either way. We can, let's say here, we can just say 2, then we can say plus, and then we multiply this, we multiply it So we multiply it by this, and then we close, and then we can still get the 5% as the cost of equity. So this is the expected return on investment if investors want to inject their money into want to buy equity into a company. So, which is cool. Then let's go over to the inputs section or column. Here we have got long-term debt, we've got common equity, we've got total capital, debt to total capital ratio, equity to total capital, and then cost of debt, tax rate, and after tax cost of debt. So let's just say we have got the company wants to raise, let's say, $1,000 in debt, and then wants to raise let's say $2,000 in equity, and then let's just sum up to get the total, just like that. So now we can calculate the debt to total capital ratio. So we can just say 1,000 divided by 3,000, and we can turn that into a percentage, old HP, old H0, and then we can just do the same for here. We can divide for equity. We can say old HP, old H0, just like that. So here you can see that the proportion of debt to total capital is 33.3% and 66.7%. So which means, mind you, that when a company raises debt, it only has to pay interest payments, of which the interest payments are tax deductible, right? But when the company, so this doesn't dilute the shareholding, or the number of shares. But when the company raises equity, then it dilutes the earnings per share, right? So that's so which means the earnings, if I say it dilutes the earnings per share, it means the earnings per share can reduce, it can be reduced by issuing additional equity, right? So in under normal circumstances, the company is better off raising debt than common equity, right? But that's just that. Then we have got cost of debt. This is the interest rate. Okay, so let's just set the interest rate to, let's say, 8%. Okay, so let's just say okay, so old HP, old H0 get 8%, and the tax rate, let's just set it to 15%. So old HP, old H0, then we get 15%. Let's just set that to percentage, this cell. So G12, so old HP, old H0, just like that. So here what we are doing is we want to use an after-tax cost of debt. In other words, we want to use a cost of debt that that doesn't include the or in fact that showcases that we have already removed the tax benefit from it. Okay, so let's just say this times, and then we can say 1 minus tax rate, so we get 6.8%. So what's essentially happening here is, instead of the company being charged the 8%, because it's a company that is raising debt, it is now paying 6.8% on the debt. That is, instead of just saying paying, being charged 8%, the company is now being charged 6.8%. So it has got a tax saving of the difference between 8 minus 6.8%. That's the tax benefit. All right. So let's just put here because here I think we need, these are all percentages. Yeah, so let's just turn all those cells into percentage, Alt HP, Alt H0, just like that. So here we can pull the debt to total ratio, which is this one, and here we can pull as well this one, and here we can pull the after-tax cost of debt, and here we say this multiplied by this. So we can just do this, and so here is a percentage, right? So here's a percentage, let's just say 2%, but let's just add a decimal place, so Alt H0 there, so which is, it translates to 2.3%. Then let's link the equity, and let's link the cost of equity, which is this one, and then here we want to say this multiplied by this to get 3.3%. so now we can say that plus this. Okay, so let me just Alt H0 there. So the overall cost, the weighted average cost of capital is 5.6. So what this essentially means is this is the cost of raising both equity and debt. Okay, so here is the formula here. So I think that I haven't done justice to this tutorial, to this section where we talk about the cost of equity and debt. Please feel free to let me know in the comment section. If you feel that there is some area that you need me to clarify more, then also let me know in the comment section as well. Right, so if you haven't subscribed to this YouTube channel, please do so. And if you really like this tutorial, or like all of our videos that we are uploading, please like and comment and share these tutorials with your peers. Don't forget to subscribe.